Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Good to be back.
It is Tuesday, February 17th, 2026. And if you were trying to place orders yesterday, you probably noticed the liquidity was a little thin.
A little thin is an understatement.
Right. U.S. markets were closed for President's Day, and of course a huge part of the Asian session was offline for the Lunar New Year.
It was a quiet day on the screen, for sure. But, as we know, the news cycle, it doesn't really care about market holidays.
No, it does not. Sometimes the silence on the trading floor just makes the headlines feel, I don't know, louder.
It really does.
And looking at our stack of sources today, anxiety just seems to be the word. We're waking up to a market that's grappling with some very specific AI jitters, a really mixed bag of inflation data, and some fascinating geopolitical stuff, touching everything from, thermal satellites to Cuban cigars.
It's a heavy stack today, yeah. We're pulling from Yahoo Finance, CNBC, Bloomberg, and Reuters to really piece this whole landscape together.
Okay, so let's get right into the lead story. For the past, 2 years, the AI trade has been the easiest money on Wall Street. You just buy the chip makers and go to the beach.
Pretty much.
But the NASDAQ just booked its 5th straight weekly drop. I mean, that's a streak we have not seen since the bear market of 2022.
The easy money phase is, I think we can say, officially over.
The narrative is shifting. We're not just talking about building AI anymore. We're talking about the fallout from actually deploying it. And there was this really striking piece in Yahoo Finance this morning. They were quoting Tim Urbanovich from Innovator Capital Management.
And Urbanovich is usually pretty measured, but he didn't pull any punches on this one. He explicitly called it the dark side of AI.
The dark side. That sounds ominous.
Well, he's talking about the shift from the hype phase, where a rising tide lifts all the boats, to what he calls the disruption phase.
Where the technology starts sinking specific ships.
Exactly. He called AI a legitimate threat to certain industries right now, not in 10 years, right now.
And we actually have a smoking gun for this, don't we? The freight and logistics sector.
Yeah.
The C.H. Robinson story is just, it's wild.
It's the canary in the coal mine. So C.H. Robinson, that's ticker CHRW, and Universal Logistics, ULH, these are giants in the freight world.
They're the middlemen, right? They make sure the stuff gets from the factory to the shelf.
Exactly. And their stocks didn't just stumble last week, they fell off a cliff. C.H. Robinson was down 11%, Universal down 9%.
For a low beta industrial stock, an 11% move is a crash. And this wasn't an earnings miss.
No, and that's the scary part. The fundamentals for the current quarter were fine. The sell-off was triggered by a headline from a competitor. Some Florida-based logistics tech company announced a new AI tool.
And what was the claim?
Simple, but devastating. They can now scale their freight volumes significantly without increasing their headcount.
Scale without headcount. I mean, that is the holy grail for margins, but it's the grim reaper for labor.
It is the definition of agentic AI.
We hear that term thrown around a lot. So for a listener who just thinks chatbot, what is the real difference with agentic AI?
Okay, think of it like this. A chatbot is an intern. You give it a prompt, you check its work, you guide it.
Right.
Agentic AI is a manager. It has permission to execute. So in logistics, it doesn't just write an email to a trucker. It identifies the load, it negotiates the price in real time, it books the truck, handles the insurance. It does the whole job autonomously.
So if C.H. Robinson's model is built on thousands of human brokers making calls and taking a cut.
And a competitor can now do that with just server costs. Your margin compression is, well, it's inevitable. That is why the stock tanked. Investors are betting against the human-heavy model.
This really feels like the moment where the rubber meets the road. We've been pricing in the creation of this tech, but maybe not the destruction of the incumbents.
That's the dark side Urbanovich is talking about in that Yahoo Finance piece. The market is finally waking up to the fact that AI is not just about buy tech, it's also about short the disrupted.
Which, of course, creates a very tense social situation. If you've got white-collar jobs just evaporating, governments are going to step in. Which brings us to the UK.
Right. The regulatory hammer is coming down. CNBC is reporting on a pretty significant move by the UK Prime Minister Keir Starmer. He's closing what he calls a loophole in the Online Safety Act.
Usually closing a loophole is just political speak for some minor tweak. This sounds more serious.
It is. The catalyst was very specific. Reports came out that Grok Elon Musk's AI on X was generating explicit images, including deepfakes of children. That was the line.
And I'm guessing the defense was the classic, We just provide the tool. We're not responsible for the user's content.
That defense is basically dead in the water in Europe now. Starmer's new rules mean chatbots, Grok, ChatGPT, Gemini, all of them, are now subject to illegal content duties.
So they're treated more like publishers than tools.
Exactly.
What are the teeth here? Is it just a fine they can write off?
The ultimate threat is blocking the service entirely in the UK. That's the nuclear option. But the trend is what's really important here. CNBC is framing this as the beginning of the age of verification.
Verification of age. Or identity.
Both, really. I mean, look around. Australia's already banned social media for kids under 16. Spain's enforcing a ban. France, Greece, Italy, they're all drafting similar laws.
It feels like the era of the anonymous open internet is just colliding with this new mandate for safety-first AI.
And there's a really interesting nuance in how they're regulating. It's not just about policing the output anymore.
What do you mean?
It's a fundamental shift. Before, it was clean up your platform or we'll fine you.
Yeah.
Now it's you must design your safety protocols into the code before you even launch. They're calling it safety by design.
That would slow down development cycles immensely. You can't just move fast and break things anymore.
Not if you have to prove to a regulator you won't break any in first. It raises the cost of innovation, and frankly, it builds a moat around the big guys. Only Google and Microsoft can really afford that level of compliance.
So the West is tapping the brakes, adding safety rails, worrying about jobs. Meanwhile, I'm looking at this report on China, and it feels like they are playing a completely different sport.
Oh, they're slamming on the gas. This piece from CNBC on the AI arms race, it really challenges the whole assumption that the U.S. has this insurmountable lead.
The big number is the National AI Fund. Beijing just earmarked 60 billion yuan. That's nearly, what, 9 billion US dollars?
It's a huge injection, but the strategy behind it is what matters. They've launched this AI Plus initiative. While the UK is worried about deepfakes, China is all in on industrial integration.
Bolting AI onto everything, manufacturing, agriculture.
Everything. And the really alarming part, at least for US policymakers, is the hardware. The report says Chinese models are closing the performance gap way faster than predicted, and they're doing it using Huawei chip clusters.
Wait, I thought the sanctions were supposed to stop that. Wasn't that the whole point of banning NVIDIA's top chips?
The sanctions created friction, no doubt, but this report suggests they also forced domestic innovation. Huawei had to build a workaround, and it looks like they're succeeding. The whole containment strategy might be failing.
And it's not just a two-horse race. U.S. versus China. You flagged a huge number coming out of India.
The Adani Group, you know them for ports, power plants? Well, they just announced a $100 billion investment plan.
100 billion with a B.
Over the next decade, yeah. And it is strictly for AI data centers and the energy infrastructure to power them.
That is just a staggering amount of capital.
It signals that data sovereignty is the new national security. India doesn't want to be renting compute from Amazon or Microsoft forever. They want to own the physical layer of the AI age.
Okay, let's zoom out. We've got labor disruption in the U.S., a regulatory crackdown in Europe, and a massive infrastructure build-out in Asia. That is a chaotic backdrop. But for the average investor, the thing that really matters is still the Fed.
Yes. The boring macro data is still the captain of the ship.
And the shift seems to be steadying. I saw CNBC Daily Open is reporting that the Wall Street Journal has officially declared the soft landing has been achieved.
It's a bold declaration, a little premature, maybe. But the data does support the optimism. We got the January CPI numbers before the long weekend. Headline CPI rose 2.4% year on year. That's down from 2.7% in December.
And core CPI, because that's what the Fed really watches.
Core is at 2.5%. That is the lowest we've seen since April of 2021.
2021. That feels like a different economic lifetime ago. So if inflation's down at 2.5%, surely the Fed has to cut rates soon.
You'd think so. But the market is still hesitant. The 10-year Treasury yield is just hovering around 4.02%. It isn't crashing.
So why the hesitation?
It's the discrepancy between CPI and PCE. The Fed's preferred measure is the Personal Consumption Expenditures Index, PCE, and that doesn't come out until this Friday. So until that number confirms the trend, the Fed isn't moving.
Plus, we have the Fed meeting minutes on Wednesday.
Exactly. So the soft landing might be here, but the rate cut party is still on hold. And there's a bit of a catch-22. If the economy is actually doing too well, the Fed has no reason to cut rates aggressively.
Which explains the strange behavior in gold. Usually with a soft landing, you'd sell a safe haven like gold. But banks are raising their price targets.
It's very counterintuitive. Bloomberg had a piece on gold dipping below $4,900 an ounce, but that was mostly thin trading and some profit taking. The big banks, Deutsche Bank, Jefferies, are telling clients to buy this dip. Jefferies is calling for 5,000 plus.
What's the thesis behind that?
In a word, dollar debasement. They aren't buying gold because they fear a recession. They're buying it because they fear the debt. Even with a soft landing, the U.S. deficit keeps expanding. They're looking for a store of value that can't be printed.
So gold is a hedge against the government's balance sheet, not the economy's performance. That's a crucial distinction.
It is. And, while we're on commodities and scarcity, there was a smaller, kind of sad story that highlights how fragile these global supply chains really are.
You mean the Cuban cigar crisis?
It sounds trivial, but for Cuba, it's an economic tragedy. CNBC reported they've suspended their annual cigar festival.
And this isn't just a party, this is their Super Bowl for exports, right?
It brought in $827 million in foreign currency last year. That's a lifeline for them.
So why cancel it?
No fuel. They literally don't have the electricity or gasoline to host it. The report points to the tightening U.S. blockade and, crucially, the collapse of oil support from Venezuela.
Wow. It's a stark reminder. We're over here worried about AI taking our jobs, and 90 miles away, they can't keep the lights on to sell their most famous product.
It really illustrates the weaponization of trade. Whether it's high-end ships to China or oil to Cuba, economic warfare is very real.
Okay, let's pivot to a lightning round. We've got some specific corporate movers to hit. First up, Massimo, ticker MASI.
This was a huge move. The stock surged 30%.
30% on a rumor.
A very credible one. Yahoo Finance and the FT are reporting that Danaher, the life sciences giant, is looking to acquire them for potentially around $10 billion.
Massimo has been in a lot of fights lately. The Apple Watch patent dispute, proxy
Whoa.
battles.
And that's why this makes so much sense. A takeover ends all that drama. It's a classic consolidation play. For anyone holding Massimo, this is the exit they were praying for.
Speaking of drama, Norwegian Cruise Line, NCLH.
Activist alert. Elliott Management has built a 10% stake.
And when Elliott Management shows up, the CEO usually starts updating their LinkedIn.
Investors love it. Management hates it. Elliott will push for a sale, a breakup, something. Given the debt the cruise lines took on during COVID, Elliott probably sees a way to restructure and squeeze out some value.
So expect turbulence there.
Mm-hmm.
All right, finally, this piece of tech that sounds like it's straight out of a spy novel, Satvu.
This is a UK space startup. Reuters reports they just raised another £30 million, about $41 million. But the lead investor is the headline here, the NATO Innovation Fund.
NATO is a VC now.
They kind of have to be. The tech is what they call dual use. Satvu uses satellites for high-resolution thermal imaging.
So they can see heat from space.
With incredible precision, they can look at a factory roof and tell you if the machines inside are running just based on the heat signature.
So for an ESG investor, you can verify energy efficiency. For a military commander,
you can see where the tanks are hiding.
Yeah.
Exactly. It reinforces the whole theme. The line between commercial tech and defense tech is it's blurring completely.
it brings us full circle, doesn't it?
Yeah.
We start with AI agents watching our workflows. We end with satellites watching our heat signatures.
The theme of the day is visibility. AI makes labor visible and replaceable. Regulations are making code visible and liable, and satellites are making physical activity visible to the whole world.
There's really nowhere to hide. So, distilling this all down for our listener, what is the mission takeaway from today?
I think the takeaway is don't trust the calm. The macro averages, inflation, GDP, they look calm, like a soft landing. But under the surface, the individual components are violent. You have sector-specific depressions, like in logistics, you have geopolitical strategies failing, and you have supply chains snapping.
So you can't just buy the index and go to sleep. You have to really look at what you own.
You have to ask yourself, is this company a disruptor or is it one of the disrupted? Because the gap between those two is just getting wider every single week.
And that leads right into my final thought for you to chew on today. We talked about that Florida logistics company using AI to cut headcount and scale up. It's easy to see that as just a stock ticker story.
But it's a personal story for a lot of people.
It is. So I want you to think about your own job, your own daily tasks. If a startup pitched your CEO tomorrow and claimed they could do 80% of your department's workflow with an agentic AI for a tenth of the cost, how defensible is your position? Are you the bottleneck or are you the architect?
That is the uncomfortable question of the decade.
It certainly is. Yeah. Something to think about as you head into your Tuesday. A huge thanks for for breaking down the stack with us.
Always a pleasure.
And thank you for listening. We'll see you all tomorrow morning with new headlines from major financial magazines.